I have spent a very long time watching how people talk about inflation. And the first thing I learned is that most people do not recognize it until it has already started eating them alive. They think inflation arrives like a thunderstorm. They think it is some mysterious accident. They think it blows in from oil fields, wars, supply chains, shipping lanes, greedy grocers, difficult unions, foreign governments, or bad luck. That is the story ordinary people are taught, because it is easier to manage a frightened public when you give them a villain they can point at instead of a mechanism they can understand. But if you stay around markets long enough, and if you are willing to look at a monetary system without sentimentality, you begin to see something much colder. Inflation is not an accident. It is a policy choice. It is a transfer mechanism. It is one of the oldest ways in the world to move purchasing power away from people who save in currency and toward people who own productive assets. That is the part most people never absorb until late in the game. They think the danger is losing nominal money. Very often the real danger is keeping nominal money and discovering that it buys less every single year while you are being told nothing unusual is happening. I want to make this concrete. Imagine a man who does everything the respectable way. He works, saves, avoids foolish speculation, keeps cash in the bank, maybe owns a government bond or a pension fund full of them, and tells himself he is being prudent. He is not reckless. He is not over-leveraged. He is not chasing nonsense. He believes caution is protection. Then 5 years pass. His savings account still exists. His bond still exists. His pension statement still arrives on time. Nothing dramatic has exploded. Nobody has confiscated anything. No one has broken into his house. No one has drained his account on paper. Everything still looks respectable. But the house he hoped to buy costs far more. The grocery bill is absurd. The energy bill feels insulting. Restaurant prices have detached from memory. A simple jar of coffee, the kind nobody would have thought twice about a few years earlier, has become a little lesson in monetary decay. His money was not stolen in one violent act. It was diluted, thinned, watered down quietly and continuously. That is why currency decline is so dangerous. It does not always feel like a crisis at first. It often feels like irritation, then strain, then disbelief, then a pattern, then a rush. And the rush is the part I want you to understand. Austrian economists had a phrase for the late stage of this process. They called it the crack up. Boom. That phrase sounds theatrical to modern ears, but the underlying logic is brutally simple. The moment enough people understand that the authorities are not going to protect the currency, they stop treating currency as a store of value and start treating it as a hot potato. At that point, behavior changes. People stop asking, "Should I save more cash?" They start asking, "What can I buy with this cash before it loses more value?" That shift is everything. It does not begin with panic in the streets. It begins with small acts. People buy supplies earlier than usual. They restock faster than usual. They bring purchases forward. They buy homes at prices they would have mocked a few years earlier, because at least a house is a thing. They buy metals, land, producers, anything with scarcity, anything with usefulness, anything that is not merely a promise written in the language of a weakening currency. That is how a crack-up boom develops. It is not driven by confidence. It is driven by retreat from money itself. The first thing I want to tell you is that most people will recognize this process too late, because they watch the wrong scoreboard. They watch official inflation numbers that have been massaged, reweighted, softened, and interpreted for them. They watch futures prices without asking whether physical reality agrees. They watch central bankers speak about fighting inflation while ignoring the one thing that actually matters, which is the quantity of money and credit being pushed into the system. I prefer a different scoreboard. I look at money supply growth. I look at the balance sheets of central banks. I look at whether the authorities are truly tightening or whether they are merely pretending to, while quietly reopening the liquidity valves the moment markets or governments become uncomfortable. I look at the bond market because government bonds tell you whether the public still believes the currency has discipline behind it. And I look at how quickly real things are being repriced relative to monetary things. When those measures start aligning, You do not need an official declaration. The process is already underway. Take housing relative to gold. Most people look at house prices in pounds or dollars and tell themselves housing is strong. That is a lazy conclusion. Houses do not become more valuable merely because the local currency becomes less trustworthy. Sometimes what you are actually seeing is not real estate strength but monetary weakness. The distinction matters. If house prices keep rising in currency terms while gold is rising even faster, that is not a healthy sign of prosperity. That is a sign that people increasingly prefer scarce real assets to the currency used to quote them. When ratios that have held for decades begin to break, the message is not subtle. It is telling you that confidence in the monetary unit is slipping faster than most people realize. The same thing happens with oil. People love to say oil is causing inflation. That explanation is comfortable because it turns a monetary event into a commodity event. But oil does not create inflation. Oil can reveal inflation. Oil can amplify inflation. Oil can expose the vulnerability of a currency system already burdened by too much money and too much debt. But a temporary rise in oil does not create a multi-year destruction of purchasing power by itself. You do not get persistent inflation unless the monetary authorities validate it. That is the key distinction. If governments and central banks were committed to monetary discipline, spikes in commodities would be painful, but they would not become the foundation of an enduring inflationary regime. What turns pain into regime change is policy. The printing, the deficits, the monetization, the refusal to allow liquidation, the refusal to let bad debts clear, the insistence on supporting every large liability structure, no matter how rotten it has become. That is where the real inflation comes from. And once you understand that, you stop waiting for politicians to rescue you from the thing they are incentivized to continue. That is the second point. Governments with large debts and large promises do not have the temperament for hard money. They have the temperament for managed erosion. Austerity is politically painful. Default is politically humiliating. Inflation is politically survivable because it can be blamed on almost anything. That is why cash becomes dangerous in the late stages of debt saturation. Not because it disappears overnight, but because it becomes the preferred instrument of quiet confiscation. People hear that and immediately say, "But cash yields something now." Yes, it often does, and still it can be a trap. A 4 or 5% yield feels rational until the currency itself is losing purchasing power faster than that. Then the yield is not income, it is consolation. It is a small rebate for standing in the wrong line. The same problem appears in government bonds. For 40 years, investors were trained by a great bond bull market. Yields fell. Bond prices rose. Financial assets levitated. Cheap credit supported governments, households, corporations, and asset valuations all at once. A generation of people came to believe government paper was the conservative anchor of a portfolio. That belief becomes extremely dangerous when you move from a long era of falling yields to a long era of rising yields. A bond that pays a fixed return can look stable on a statement, but if new bonds begin offering higher yields because inflation expectations and fiscal risk are climbing, the value of the existing bond falls. Your principal deteriorates while your purchasing power deteriorates too. You are being pinched from both sides, market value on one side and real value on the other. That is why I would rather own productive businesses and scarce assets than a promise to be repaid in a unit that the issuer has every incentive to dilute. And let me be very clear about something. This does not mean I believe every stock is safe. It does not mean every hard asset will be wise. At any price, it does not mean all real estate is good. All commodities are timely. All gold purchases are disciplined, or all businesses are robust enough to survive a currency storm. There is a difference between real assets and merely expensive assets. I want productive things. I want businesses that sell necessities, not fantasies. I want enterprises that can raise prices without destroying demand. I want low leverage where possible. I want balance sheets that do not depend on permanent cheap credit. I want land that serves a purpose. I want metals that cannot be printed. I want ownership claims tied to reality, not paper claims tied to policy hope. This is where many people make their mistake. They hear a warning about inflation, and they sprint into anything that sounds tangible. That is not discipline. That is substitution panic. The better framework is this. When a currency system weakens, the wrong place to hide is where the nominal value is stable, but the real value is decaying. The right place to hide is where value is tied to something scarce, useful, productive, or all three. That is why I would rank the danger zones very plainly. Cash is dangerous. Long government bonds are dangerous. Pension structures overloaded with government paper are dangerous. Any portfolio built on the assumption that nominal safety equals real safety is dangerous. And on the other side of that divide, I prefer businesses that make real things. Energy producers that own reserves, selected real estate with actual utility, and monetary metals held not as speculation but as insurance against the arrogance of monetary managers. You will notice I did not say that everyone should put everything into gold. That would be a childish simplification. Gold is not a productive business. It does not innovate. It does not generate a stream of growing cash flow. But it does one job better than almost anything else. It stands outside the political promise machine. It has no board meeting that votes to dilute you. It does not depend on the honesty of a finance ministry. It does not require the discipline of a parliament. It just exists, indifferent and finite. That is why gold tends to do its best work, not when everything is calm, but when people begin realizing that calm was being rented with debt and liquidity all along. Silver can serve a similar role, though with more volatility and a different industrial character. Then there are stocks. In a currency crisis, the public often gets confused by stock indices making new highs and concludes the economy must therefore be healthy. That conclusion is often ridiculous. Sometimes stocks are rising not because businesses are suddenly wonderful, but because the unit used to price them is deteriorating. A stock market at an all-time high can coexist with a society getting poorer in real terms. That is why you must separate nominal performance from real performance. If the currency is weakening rapidly, stocks may rise. The question is which stocks and by how much relative to what you are trying to preserve. I do not want glamour financed by cheap promises. I want durable enterprises, selling energy, food, infrastructure, repair, materials, logistics, basic goods, and services that continue to matter when households and businesses are under pressure. I also want to avoid the trap of thinking I need to predict the exact day the next phase begins. Trying to time a monetary fracture with precision is one of the fastest ways to make yourself stupid. The point is not to ring a bell at the top of cash and the bottom of gold. The point is to recognize that once the system has crossed certain thresholds, the direction of policy is no longer a mystery. The authorities will try to preserve nominal order by sacrificing the currency rather than preserve the currency by allowing a politically intolerable liquidation. Once you understand that, you do not need perfect timing. You need proper positioning. That means getting out of the illusion that safety is the same thing as stillness. A savings account looks still. That does not make it safe. A government bond looks respectable. That does not make it safe. An index-linked promise from an overstretched system may look official. That does not make it safe. Real safety in a diseased monetary environment comes from owning things that either retain purchasing power or adjust with the debasement faster than your liabilities do. There is another part of this story that matters just as much, and it is behavioral. Most people wait for headlines to give them permission to act. They wait for a minister to admit the problem. They wait for a central banker to use the word crisis. They wait for a newspaper they already trust to validate what their eyes and receipts have been telling them for months. By then, the easy repricing is already behind them. Gold does not wait for public consensus. Real estate in desirable areas does not wait for public consensus. Quality businesses with real assets and pricing power do not wait for public consensus. The public gets invited only after the first move has already happened and after the safest valuations are gone. That is why I prefer acting when the evidence is structural, rather than when the mood is unanimous. And the structural evidence today is straightforward. Money supply is expanding again. Central bank balance sheets are no longer truly shrinking in a meaningful way. Governments are too indebted and too politically boxed in to defend currency, purchasing power honestly. Bond markets are beginning to behave like long-duration promises should behave in a higher inflation regime. Daily life is flashing signals that people dismiss as anecdotes until they become habits and then necessities. When enough of those signals line up, you do not need to wait for the final act to begin protecting yourself from it. I have no interest in selling you fear. Fear without structure is useless. What I want is clarity. If the system keeps going the way it has been going, cash will become poorer refuge. Government bonds will become poorer refuge. The people who think nominal stability is enough will discover too late that they were measuring the wrong thing. And the people who own the right scarce and productive assets will not look brilliant because they predicted every twist. They will look brilliant because they respected incentives and positioned for what heavily indebted governments always prefer. They prefer inflation to honesty. They prefer erosion to default. They prefer narrative management to discipline. They prefer that you remain in the polite line for cash and paper, while the real transfer is happening elsewhere. I would rather step out of that line while it is still orderly. That means I want less devotion to currency, less devotion to fixed promises denominated in weakening units, more devotion to ownership, more devotion to productive capacity, more devotion to scarcity, more devotion to things that survive when confidence in policy begins to thin. This is not about becoming paranoid. It is about becoming harder to impoverish. There is a difference. Paranoia sees danger everywhere and flails into random assets. Discipline sees the mechanism, identifies the transfer, and quietly moves toward the side of the ledger that benefits from it. That is the work now, not waiting for reassurance. Not pretending this is temporary, because temporary feels emotionally easier. Not hiding in instruments that were rewarded in the last regime, and assuming they will be rewarded in this one. The old game was to own long paper, while yields fell and policymakers were credible enough to keep the fiction orderly. The new game is different. In the new game, I would rather own what governments need, what households still buy, what cannot be printed, what produces, what endures, and what gets stronger as faith in the currency gets weaker. If you understand that, then you understand the real choice in front of you. It is not cash versus risk. It is not prudence versus speculation. It is whether you want your savings sitting closest to the source of deliberate dilution or furthest from it. And in a period like this, that decision can define an entire decade of your financial life.